Hello and welcome to this video. My name is Vincent SDFX and today I'm going to be showing you essentially how you can find and trade institutional order blocks. So without further ado, let's get into it. Now, to start off, you need to ask yourself, why does price react from this order block and not from this order block? It's because not every order block is valid or tradable. And I set up a set of criteria which an order block has to match for me to even think about trading it. And I'm going to show you exactly what those criteria are right now and how to apply them. Alright, so first off, the order block either takes out liquidity or has opposing liquidity to take. Why is this? Well, it's called an order block for a reason, right? Basically, the algorithm's task is to go to where the most orders and liquidity are stacked. Therefore, it will 90% of the times first build up liquidity, then take it out, and then it will make a move. The reason for this is because the BFI's orders are so large that price has to induce people into the market. And with inducing, I mean let them place their stop loss at a certain point. And these stop losses obviously are orders. So the BFIs are then able to collect them and fill up their own orders. Whether that's them opening positions or closing positions is irrelevant because we trade with the BFIs and not against the BFIs. The second rule is order block must break structure or change character in line with current price action. So the reason for this is very simple, because when price has enough force or strength to break a low or a high, it means big orders came into the market. And what the BFIs will do is they will protect their order, and therefore taking into mind that their orders are stacked at the low or high which broke structure, we can now assume that that high or low is protected and price won't break it. Now the next criteria is that the order block has to be in premium or discount. So if we're in a downtrend looking for shorts, the order block has to be in a premium price area. And if we are in an uptrend looking for buys, the order block has to be in a discounted price area. How you can measure this is by taking your Gantt box and measure the move. I consider premium or discount above or below 50% of the previous move. This is because price will tend to retrace at least 50% of the previous move before continuing in its trend. The next criteria is that the order block has aggression or imbalance. This is an institutional footprint. The reason for this is that imbalance or aggression in the market shows that big orders came into the market. You want the imbalance to come straight out of the order block because this shows exactly where the BFI's orders came in. So now that we know exactly how to find institutional order blocks, I'm going to take you into a couple of live market examples of trades I actually took for you to understand completely what I mean. So let's get into it. Alright, so what I want you to do is I want you to pause this video and right now look which order block is valid. Okay, so what do we see? On the 50-minute, we see that price on the lower time frames here takes out a level of trendline liquidity right here, and we see that price on the 3-hour formed a very clean institutional order block right here, and price hasn't mitigated it yet, but this now is opposing liquidity to take. So this is liquidity to take. Then we ask ourselves, does it break something significant in line with current price action? Yes, it does. It breaks this low right here, breaks and closes below right at this point, break of structure. Then, does it have imbalance or aggression coming from it? Yes, right here we still have an imbalanced price area right between these two candles. It's not a big imbalance, but it's imbalanced, so it's according to our rules. And now we ask ourselves, do we have liquidity target? Yes, we do, because we have a weak low right here. So that will be our target. When we look, now, if you want to take an entry, you can put your entry right on the order block, but your stop loss, you can place your stop loss right above the close of the order block, because orders get filled right in here. So this will be our entry stop loss, and this will be our target. So like this. Wait for price to come in, we get tapped in, and price runs to our target. Now, this is one example of how you can use the criteria I just showed you, but I'm going to show you another example. Okay, so for this example on NCD CAD, we see that price is in a downtrend because it is making a series of lower lows, lower highs, lower lows, lower highs, lower lows, and lower highs. So we are looking for shorts. We also see that price is continuously respecting supply zones. So mitigation, continuation, mitigation, continuation, mitigation, continuation, mitigation, continuation, mitigation, continuation, and mitigation, continuation. Then when we zoom in to the 1 hour, we see here the price has taken out this liquidity right here, liquidation, and it has made a change of character to the downside. Now we see that price right here has respected this supply zone, and it is willing to go further down because it has also made a break of structure to the downside. We also see right here, if we zoom in even more, we see that price has formed these equal highs and has taken them out. So this we count as a liquidation of buy side liquidity, and price, as we can see, has left this institutional order block unmitigated and imbalanced. So right now we grab our set of rules. So we ask ourselves, does the order block take liquidity or have opposing liquidity to take? Yes, it takes liquidity. It doesn't really have any opposing liquidity to take, but it is or, not and. Does it break something significant? Yes, it breaks structure to the downside right here. Then we ask ourselves, it is in premium or discount? Yes, it's very much in a premium price area. Does it have aggression or imbalance? Let's zoom in. Yes, it still has this unmitigated imbalance right here. And do we have a liquidity pool to target? Well, when we zoom out, what was our last high? Was right here, and which low put in that high is right here. So if we're in a downtrend, this low right here is weak. So we call this a weak low. We can also see that right here we have all this sell side liquidity ready to be taken out. So this right here will be our target. And as I said in the last example, we put our entry at the low of this candle and our stop loss just above the body close. And for our take profit, we will target this weak low right here. Then we wait, price taps us in. And because we are trading pro trend, price is moving very fast. So it runs almost straight to our target. Now I gave you the keys to why you are being stopped out on your order block entries. It's because you didn't know the criteria before. Now that you know the criteria, I highly encourage you to go back to the charts and backtest this for yourself. You will see that with these rules, these order blocks are very accurate and price reacts to it very accurate as well. So if you find this video informative, I ask you to subscribe and like this video. And thank you for watching, and I see you in the next one. Ciao.